On a map of Europe, Luxembourg looks almost like a typo. It's this tiny sliver of land wedged between France, Germany, and Belgium. No coastline, no oil fields, no vast factories. Its population is barely 660,000 people, which is smaller than many neighborhoods in London. And yet, per person, Luxembourg is richer than almost every country on earth, richer than the United States, richer than Switzerland, richer than Norway. So either Luxembourg found a secret gold mine that no one talks about, or something much stranger is going on. Because Luxembourg didn't get rich by saving more, it got rich by becoming the place where everyone else's money goes. And right now, in a world where capital moves at the speed of light, that matters more than ever. The countries that win aren't always the biggest or the most productive. Sometimes they're just the most convenient. And Luxembourg understood that very early on. After World War II, Luxembourg wasn't a financial powerhouse. It was an industrial economy built entirely around steel. For decades, steel exports powered its growth. But by the 1970s, the global steel market was collapsing. Competition was rising, prices were falling, and factories were closing. For a small country, that kind of shock can be fatal. Luxembourg had a choice: shrink quietly or completely reinvent itself. It chose reinvention, but not by building more factories. It chose to reinvent itself by building a legal system. Starting in the 1960s and 70s, Luxembourg began crafting laws that made it extremely attractive for foreign banks and investment funds. Low taxes on certain financial activities, flexible corporate structures, strong banking secrecy, political stability, and crucially, membership in what would later become the European Union. That combination was incredibly powerful. If you were an American fund manager who wanted access to European investors, Luxembourg offered the perfect solution. If you were a multinational corporation looking for a tax-efficient holding structure inside the EU, Luxembourg had the paperwork ready, and it worked spectacularly. By the 1980s, banks were flooding in. By the 1990s, investment funds were pouring in. Today, Luxembourg is the second largest investment fund center in the world, right after the United States. Not second in Europe, second in the world. Trillions of euros flow through this country. On paper, that phrase, on paper, matters a lot. Because when we say Luxembourg is rich, we need to be very precise. Its GDP per capita is extraordinarily high, but GDP counts the value of goods and services produced inside a country. And in Luxembourg's case, a huge share of that production is financial intermediation, the business of managing, structuring, and routing money. Imagine you manage a global investment fund, you register it in Luxembourg. Investors from Germany, Italy, and Spain buy shares. The assets themselves might be stocks in Japan, bonds in the US, or real estate in Canada. But legally, the fund sits in Luxembourg, management fees get booked there. Administrative services get paid there, profits pass through there. All of that shows up in Luxembourg's GDP, even if the real economic activity is happening somewhere else. This is where the uncomfortable math begins. Luxembourg's financial sector is enormous. Relative to its size, the assets held by banks are many times larger than the country's entire economy. Investment funds domiciled there manage trillions. Many corporate entities registered there have little physical presence beyond an office and a mailbox. It's not illegal. It's not secret in the way people imagine offshore islands to be. It's just highly optimized. Luxembourg essentially turned itself into Europe's financial plumbing. And plumbing doesn't need to be flashy. It just needs to work. There's another piece that makes the numbers look even more surreal. Every weekday, around 200,000 people commute into Luxembourg from neighboring France, Germany, and Belgium. That's nearly half the country's workforce. They earn high salaries in Luxembourg's economy, but many of them live and spend a good portion of their income back home. Their output counts toward Luxembourg's GDP. But they aren't counted in the resident population when you divide that GDP by the number of people. So GDP per capita shoots even higher. It's a statistical amplifier. Add to that the profits of multinational corporations booking income in Luxembourg for tax efficiency. And you get a country that looks almost absurdly wealthy on paper. And to be clear, Luxembourg is genuinely prosperous. Public services are strong, The infrastructure is modern, wages are high, the state often runs budget surpluses, and public debt is relatively low compared to many of its European peers. This isn't a fort built on sand, but it is built on a very specific global system, one where capital is mobile, corporations are global, and tax rules are full of gaps. In the 2000s and 2010 seconds, Luxembourg became synonymous with sophisticated tax structures. Multinationals used something called advanced tax rulings agreements with tax authorities that clarified how their profits would be treated. It was all perfectly legal, quiet, technical. Then came the leaks. Investigations like the LuxLeaks scandal revealed how some of the world's biggest corporations were dramatically reducing their tax bills by routing profits through Luxembourg entities. The headlines were explosive, politicians were outraged, the public discovered that billion-euro companies were paying effective tax rates in the single digits. Luxembourg defended itself. It argued it was following EU rules, providing certainty, and that other countries wrote the broader tax framework, and in many ways that was true. Luxembourg didn't invent global tax competition, it just mastered it. Here's the irony: for years, large countries criticized Luxembourg for siphoning off tax revenue, but those same countries benefited from Luxembourg's financial infrastructure. Their companies used it, their investors used it, their pension funds used it. The system was criticized and relied upon at the same time. Quietly, reforms began. The OECD pushed for greater transparency. The EU tightened rules on state aid and tax avoidance. Banking secrecy weakened, automatic exchange of tax information became the standard, and Luxembourg adapted again. It shifted from secrecy to specialization, from being opaque to being compliant but efficient. It doubled down on investment funds, private banking, and cross-border financial services. Today, it's a hub for sustainable finance funds, a center for private equity structures, and a key node in Europe's financial architecture, especially after Brexit shifted activity away from London. The country just keeps evolving, but the core model remains the same. Attract capital, offer stability, provide legal certainty, and stay small and nimble. There is a deeper question beneath all of this. Is Luxembourg rich because it creates enormous real economic value, or because it's at a strategic choke point in the global financial network? The answer is probably both. Financial intermediation is real work. Structuring funds, managing assets, and ensuring compliance. These services matter. They enable investment and connect savers to borrowers across borders. But the scale is the key. When financial assets booked in a country are dozens of times larger than its own domestic economy, that country becomes highly exposed to global flows. If regulations change drastically, if major economies harmonize corporate taxes, if capital becomes less mobile, the plumbing might still function, but the volumes could shrink. There's also a social dimension. A high GDP per capita doesn't automatically mean every resident feels rich. Housing prices in Luxembourg have surged for years, pushed up by high incomes and cross-border demand. Inequality exists, even in a wealthy state, and its heavy dependence on foreign workers means the economy relies on daily inflows of labor from abroad. Luxembourg's success is intertwined with its neighbors. It is small, but it is deeply connected. This brings us to why this story matters right now. Around the world, governments are debating a global minimum corporate tax. The OECD's initiative aims to set a floor under how low effective corporate tax rates can go. If it's fully implemented, it could reduce the incentive for companies to shift profits to low-tax jurisdictions. For countries like Luxembourg, that changes the calculus. Not overnight, but gradually, the competitive edge becomes less about tax rates and more about expertise, regulation, and the entire ecosystem. Luxembourg seems to know this. It's investing heavily in financial education, multilingual talent, and digital infrastructure. It's positioning itself as boringly reliable in a world that is anything but. And maybe that's the real lesson here. Luxembourg got rich by identifying a niche in the global system and optimizing for it relentlessly. It accepted its smallness and then turned it into an advantage. Small countries can move faster, they can tailor laws quickly and build consensus more easily. Luxembourg became a country-sized service provider. highly skilled, politically stable, and legally precise. But here's the uncomfortable ending. If your wealth depends heavily on being the preferred conduit for other people's money, your fate is tied to forces far beyond your borders. Interest rates in Washington, tax reforms in Berlin, regulations in Brussels, capital controls in Beijing, a shift anywhere in the network ripples through. For now, Luxembourg remains extraordinarily rich on paper and genuinely prosperous in reality. But its model raises a bigger question about our modern global economy. In a world where value can be booked almost anywhere, what does it really mean for a country to be rich? Is it about what you produce? Or is it about where the profits land? Luxembourg chose the latter, and as long as the world keeps moving money across borders, that choice may keep paying off. The real question is, what happens if the world decides to move differently? Thanks for watching. If you found this interesting, don't forget to like and subscribe for more deep dives into how our world works.